All right, let's go ahead and get started. Thank you again for joining us for today's webinar on tax strategies and insights. It is my pleasure to welcome you all. Again, my name is Mahesh Odhrani with Strategic Wealth Design. Our firm is based out in Las Vegas, but I do see several individuals on the meeting over here that are attending from different parts of the country. So thank you again for joining us. A couple of housekeeping items before I introduce our speaker and our presenter, Dean. Everyone's on mute automatically. If you do have a question, go ahead and pop it in the question box. There's a question box on your GoToWebinar portal. And so please feel free to put in any questions in the question box, and we will make sure to address it definitely at the tail end when we're going to have a Q&A session with Dean. But if I see any questions popping in that are topic relevant to what he's talking about, I'll definitely pause Dean and ask him those questions as well. So feel free to pop your questions in there. And let's see, the webinar will go, our goal is to be done by about 1:45 p.m. Pacific time. And we certainly want to leave some time for Q&A as well. So please hang in there. And if we go a little over, we'll certainly let you know as well. This webinar is being recorded. So the recording will be made available in a few weeks once it goes through all our internal approval processes. So if you do end up leaving a little early, it's perfectly fine. You will receive a recording as well. So with that said, I will go ahead and introduce our presenter speaker, Dean. Dean, welcome. Can you?
Glad to be here.
Oh, thank you. Thank you for joining us, Dean. So some of you that have attended this webinar before, Dean was our guest speaker last year as well. Dean Meoli serves as the Director of Investment Planning for Independent Advisor Solutions by SEI. So SEI, for those that are on the call that work with us and our clients, they will recognize the name. SEI is our strategic partner for the investment platform that we use and is a custodian for all our clients' assets. SEI does a phenomenal job of managing the investment, the tax piece of any type of taxable investment accounts. And Dean plays a critical part of that team, providing support to advisors as well as to relationship managers and directors across the country. And in fact, our relationship director, Jack, is also on the call. So Jack, feel free to chime in if you have anything to add as we go along. So Dean is a regular contributor for blogs and different industry publications. He's also served as the financial planning technical manager at the American Institute of CPAs and spent several years for personal financial planning practice and tax technology with KPMG. So there's a lot more credentials that I'm going to spare because we want to get into this topic and really understand Dean's perspective on what's happening in the country and in Congress and see what strategies we can implement for saving on taxes and reducing our tax burden. So with that, Dean, take it away.
Thank you, Mahesh. Good afternoon, everybody. So let's get started. I mean, we have a really exciting time. You might say crazy, exciting about taxes, but there's a lot going on in Washington. Of course, the Senate just approved so we can keep the government open. Of course, it was only a short extension, and of course, in the trillion-dollar infrastructure bill hangs in the balance as we speak in the House. Of course, that was approved by the Senate. We'll see if Nancy Pelosi can rally the troops and get this approved. Past that, we have the $3.5 trillion additional package, which has some tax stuff in there, which we are going to get into because there's some potential that could get passed as well. Certainly not anywhere near that dollar amount. Could literally be cut in half. More to come on that, but certainly taxes will be part of that. So here's our agenda that we're going to focus, and we have a lot to cover, but we'll take it step by step. So let's get into it. I think it's a great time, especially where there is going to be some changes potentially to the estate and gift tax laws, and we'll talk about that. But basic documents need to be reviewed. COVID has changed everything, and I'll give you a quick story. last year, we did have some friends that happened to be afflicted by COVID and had to go to the hospital, and they had healthcare directives in place, but the people that were able to sign those healthcare directives that would authorize care could not get into the hospital because they only allowed patients and, of course, medical personnel. So what that means is that communications like we're doing right now, remote communication, signing a PDF and sending that by email, and emails in and themselves would be legal communications to medical providers. And a lot of estate planning documents address this, and they need to address remote communication. You just don't know. Okay, you don't want to be put in a situation where people can't authorize treatment. And be careful with your living wills about, especially around the words of intubation. I understand people don't want to go on life support and live potentially like a vegetable, but on the other side of this, if you were in the hospital and you had COVID and you said, I don't want to be intubated, well, guess what? You're not getting on a ventilator. So you got to be careful with some of the things that are said in these documents. So it's a good time to review these and make sure they're saying the right things and you have built-in remote communication. And on top of that, make sure all your beneficiary designations are up to date on all your retirement plans, life insurance policies. You never know what's going to happen in life. People get divorced and leave the exes as the beneficiary of IRA accounts, and that's probably the last person they want to be on this IRA account. So make sure they're up to date. So let's get into some potential tax law changes. There's a flurry of tax bills that are out there, but the one that the House just put out there from the House Ways and Means Committee, that's our chief tax writing committee. But let's talk about some of the things that potentially could go in there. Now, some good news here is the elimination of the step up is not in the House bill. And this is a good thing because this I think really would have unnerved a lot of people. So the idea of not having a step up of death is out. There is still a step up of death, which is the cornerstone of most estate plans. So when someone passes away, and let's say they had $1 million of Apple stock with a cost basis of $50,000, at death, it stepped up to $1 million. So the gain gets wiped out. As far as this exemption regarding personal per couple of $2,500, that is off the table as well. What is on the table is the current exemption amount per person is $11.7 million. That will be cut in half per person to about $5.85 million per person. Still pretty generous in the scheme of things. There's not that many Americans that have combined net worth, husband and wife, of greater than 11.7 million. But if you do, it is some time to be thinking about doing some estate planning regarding that. Okay. Portability between spouses, very important concept, meaning if I have any unused exemption of my 5.85 million, I can port that over to my spouse. When your executor files the form 706, which is your estate return. So portability between spouses is still here. Now, this is what we were showing here was if we were going to have this severe reduction in the estate and gift tax, which we're not having. So we're not going to go over this because it is not part of the House bill, and we're going to concentrate on the House bill. But I do want to bring up a few things that are really critical this year before year end. And one of the things we want to talk about is certainly getting into what the new tax brackets look like. And because everyone should understand what their marginal tax bracket is. And what I'm showing you here is 2017, just for some relative idea of tax brackets, where we are in 2021, and then where things would fall with 2022. And in actuality, what I'm showing you here, this is for a married filing jointly. So not single taxpayers, but filing jointly, where they're reintroducing this 39.6% tax bracket. But let me say this, the 39.6% bracket is actually, is going to be reinstated at $450,000. So actually a little bit lower than what this chart is showing, because this chart is showing it's going in around about 5.25, but it's going to come in around 450 for married couples and 400 for single filers. In fact, the 35% bracket is going to be quite small. But it's good to know what your tax bracket is. And really what that's telling you is what's the next dollar of income is going to be taxed at, or the value of a deduction, what's the savings. For instance, if you're itemizing your deductions and you give a little bit more to charity and you're in the 32% bracket, well, you're going to save 32 cents on the dollar in tax by making that extra charitable contribution. So when we think about tax planning, we're certainly taking into account where bracket am I in, and of course, what room do I have to move into the next bracket? There's a lot of good planning opportunities in the 10, 12, 22, and 24% bracket. In fact, this year, 2021, a married couple, you're still in the 24% bracket up until almost $330,000 of taxable income, which covers quite a few Americans, okay? And we'll be talking about some tax planning ideas, and I think there's some excellent planning ideas in these lower tax brackets, which going forward will still be there for the most part, but again, we don't know exactly where this tax bill is going to fall. I will say this, though, is that there is going to be a push by the Democrats to get a vote on this $3.5 trillion package before the end of the year, because they can use budget reconciliation, which means they only need 51 votes in the Senate. I don't think they want to waste that opportunity, because if they go to next year, there's elections next year, they may not have the slim majority they have in the House, and where they stand right now, or it's a 50-50 in the Senate, but of course the Vice President is the deciding vote and she's Democrat. They may not have that opportunity next year, okay? So this was something that we're thinking about instituting. We're not going to spend much time on this. They were talking about reinstating the Social Security tax once your income got above earned income above 400,000. Luckily, this is off the table. So there's your Social Security base for 2021, 142.8. We expect this to move up into the $147,000 range for 2022. That has not completely been finalized, but that's what our guesstimate is. So there will be a slight increase in the Social Security limit. Of course, once you reach that limit, you stop paying Social Security. The other side of that coin is you never stop paying the Medicare piece. Okay, there's the 1.45 Medicare portion, and of course you have the 6.2 Social Security portion. And if you're over a certain income limit, okay, earned income limit, 200,000 single or 250 for married, they actually put on another 0.9% on top of that 1.45. And again, that has no ceiling. It goes on forever. Now, this was another proposal by the Biden campaign about limiting the value of itemized deductions. Currently, that is off the table, which is a good thing. And what I would say is it is off the table right now, but basic tax planning would argue that we'd like to accelerate deductions in the current year and defer income. And this is a weird year because with the potential of tax rate increases next year, our general advice has changed. So we're interested in not only accelerating deductions into this year, but also income into this year. And I'll get into that in a minute. But as far as itemized deductions, there is no talk of capping them out at 28% anymore. So if you happen to be in the top bracket, which is currently 37%, you'll get full value of your itemized deductions. Now, one thing that wasn't in the Democrats' House bill, which we do think will be added at some point, is that currently there's a limit on the state and local tax deduction, which is currently at $10,000. Some people have real estate taxes that are in excess of $10,000. If they're working, they might be paying state income taxes and local income taxes on top of the real estate tax. And in many states that are, for instance, California, New York, New Jersey, which high income tax states, we've seen tax returns where that number could be 7 figures, 6 figures, 100,000, 200,000 in tax, and limited to 10 grand. Well, they're talking about potentially increasing it, but it won't be a ton. So maybe 10 to 15,000, 20,000 is a very low probability, but it could happen. So we do expect some increase in the state and local tax deduction, because a lot of the Democrat feel that that number 10,000 is way too low, and it does affect a lot of the blue states. So we do expect that to work its way back into a tax deal. Okay. So let's get into some planning opportunities for 21. And these are things that need to be done by year end, because most everyone, like 99.9% of all individual taxpayers, are on a calendar year basis, which means you have to do things by 12/31. The only thing you can really do after the year end is potentially, let's say, like an IRA contribution, or if you have a small business, potentially like a SEP or a 401k contribution. But most everything else has to be done by year end. But here's my number one planning idea, because this is really an area that the House bill is really concentrating on, which is these Roth conversions. And when I think about Roth conversions, the most important thing in contemplating a Roth conversion is this: what investments you do, what the expenses are, time in the investments, all that. If you keep those things equal, which you should for this analysis, the only thing that really matters is the tax rate you pay today versus the tax rates you'll be paying in the future. And if you could tell me that you don't think your tax rates are going down, so if your rates are going down, there's no point in doing a Roth conversion. But if your rates are going to stay the same or go higher, you should really be interested in a Roth conversion, because what you're essentially doing is getting the tax man out of the way now. And that's the most important consideration. And if you look at our deficits and you look how our government likes to spend money, we do expect taxes to go up. And let's say the Democrats fail and don't get a tax rate increase next year. It's already in the taxes, in the government tax code, that the rates are going up at the end of 2025. We're going back to 2017 rates. It's already built in. The current individual income tax rates are all set to sunset at the end of 25. So it's going to happen. It's just a matter of when. It's not an if. But getting back to tax brackets, again, the most important thing, if you're in the 10, 12, 22, or 24% bracket, I think, personal opinion, that Roth conversions are a no-brainer. And guess what? The government is looking to reduce the ability for U.S. taxpayers to actually do Roth conversions. So this is a tremendous year to be looking at doing these. So let's talk about it a little bit more. But again, the most important thing you should think about, if you could say my tax rates are going to be equal or higher than they are now, then you should be thinking about doing Roth conversions. Because the thing about the Roth conversion, which is essentially taking your traditional IRA and converting it to a Roth, and many times that does have a tax bill, but if you pay at the right rate, 10, 12, 22%, that's not bad. And then taxes are never paid again. I'm using the word never here, okay? It grows tax-free. There's no required minimum distributions. When your kids get it, if they get it, they won't have to pay tax on it. Tax-free for a long, long time. Never is a long time, last time I looked. So let's take a reason of why to convert. Well, one is you may have the ability to offset the Roth conversion. Let's say you have a traditional IRA, and by the way, you don't have to do the whole account. Let's say your traditional IRA is $300,000. You don't have to do a $300,000 conversion. You could do $25,000. It might very much depend on what bracket you are in and how much you can do and still stay within that same tax bracket. Okay, so let's say you want to do a $25,000 conversion, and that might cost you, let's say, $5,000 to do. Well, one thing you could do is pair the Roth conversion with another tax strategy. And a good one to look at is your charitable contributions. So I was talking about accelerating deductions. Well, here's the perfect opportunity. Let's say you normally give, let's say, $4,000 a year to charity. And by the way, you might not even be itemizing giving $4,000 $500 away to charity each year because you have to hurdle the standard deduction. And for a married couple, that's $25,100. So if your deductions, including your charity, don't total more than $25,100, you're just going to take the standard deduction. But what instead of giving $4,000 this year, you decide to give $20,000, meaning I'm going to take charitable deductions that I would have done in 22 and 23 and 24, accelerate those into this year. So now you give $20,000, you do a $25,000 Roth conversion. The tax cost is essentially almost zero now because of that huge charitable deduction that you just made. So pairing tax strategies can be really important. Now keep in mind that you, on your traditional IRAs, 401ks, you have to start taking distributions at age 72. Well, guess what? For a Roth IRA holder, and this is between husband and spouse, there are no RMDs. Now, that allows for additional tax-free deferral. So you do a Roth conversion at age 62, you live to 92, that's 30 years of tax-free compounding. Okay, maybe you were lucky in life, you never had to touch it. Now your kids inherit it. Okay, that 25,000 Roth conversion is now $350,000 account. They'll have to take RMDs, but guess what? It comes out tax-free to them. And they are subject to a 10-year payout, but they can wait to the 10th year before they touch anything. So very powerful, okay? Some other ideas around the Roth conversion. Again, I think this is one of the most powerful things is that if you are fortunate enough not have to top the Roth, that's the best asset you could leave kids and grandkids is the Roth IRA, okay? And one important thing is if you have to pay some tax on the Roth conversion, if you have to reach inside the IRA to pay the tax, I would not advise doing a Roth conversion. You need to have what's known as, let's say, outside assets, like a bank account with checking account, somewhere to get the dollars to pay for the Roth conversion, okay? But not out of the IRA, because then that kind of reduces the benefit of doing the Roth conversion. But there's lots of reasons to convert. Now, the other thing is, for those of you in your 60s and you're starting to get on Medicare and things like this, when you take money out of a Roth, that will not affect your Medicare premiums. The conversion will. That in the year that you convert, that money will be taken into consideration for a Medicare premium. Okay, so that needs to be looked at. But when you take withdrawals from your Roth, if you do so later in life, that will have zero effect on your Medicare premiums. Also, it will have zero effect on the taxability of your Social Security benefits as well. So there's even some ancillary benefits that could be pretty meaningful about tapping into a Roth later in life. Okay, and let me say this: Mahesh is a financial planner, and what we're trying to do is minimize your tax bill, not just in 1 year, but over your entire life. And to do that properly, we really need to work with 3 types of accounts, which is your traditional IRA or 401ks, those types of things known as tax deferred accounts, taxable accounts, just your standard brokerage account. But most people don't have the tax-free account, and that's what the Roth's all about, okay? So to get the tax temperature right, you need all 3 accounts. So that's why I'm a big proponent of these Roth conversions. And in the House bill, if you happen to be in the upper bracket, they want to limit people doing Roth conversions. In fact, they're shutting it down after 2032. You won't even be able to do a Roth conversion if you're in the top tax bracket, okay? They're going to not allow it. They're going to allow it for the next 10 years because this infrastructure bill, $3.5 trillion, they need the tax dollars. So they want people, they're trying to encourage people to do Roth conversions right now, but after that, no. So it's something that is going to be limited going further. There was a gentleman named Peter Thiel who made some fairly smart investments in his Roth. He was invested in some startup companies. And of course, he turned a very small amount of money into many, 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 many millions. And that has got the attention of Congress, and that's why they're putting all these rules around Roth conversions and who can do them, because they thought that was, I don't see why. It seems very American to me that someone did well, but they want to limit the ability for people to have these supersized Roth accounts.
Yeah, Dean, I believe the amount was $5 billion to be precise.
Yeah, that's a big number, isn't it?
That's a big number for a Roth account. Yes.
And never have to take a dime out of it. So that's an incredible sum. But again, it has caught the eye of Congress. But looking at taxation of Roth IRA distributions, there's some tremendous amount of benefits. Some of the things I would be looking at, of course, is time horizon. The 10-year Roth coast is when someone inherits, they don't have to touch the money for 10 years. They can let it grow for another 10 years before they can have to take a dime out of it, okay? Pairing it with tax strategies. The easiest one to do with is increasing your charitable contributions and pairing it with the Roth conversion. And again, the tax rate differential, very important. And I would argue in almost every case, people's tax rates are not going to go down. So I would argue for doing the Roth conversion. Number one planning ideal has to be done by 12/31. There's no limit on how much you do, but it's a one-way street. If you do a Roth conversion, there's no going back. Okay. And again, just one last caveat is if you happen to be in the 24% bracket, try to stay in that bracket for your Roth conversions. Make sure by doing the conversion, you're not going to step up into a higher tax bracket. And again, just a little handy chart. If you take money out, there's a little 5-year rule. This is a little handy chart as to whether the distributions would be taxed. But once you do a Roth conversion, that starts to get the seasoning going. You can always take out what you did conversion or put into a Roth. It's the penalty is really around the earnings, if there's going to be a penalty or not. But the principle, no. Now here's one idea that has definitely got the attention is the House bill wants to shut down what's known as the Backdoor Roth. And I'll give you my own personal situation. I've been married now 13 years, and when I got married back in 2008, my wife had a 401k, and she still does, still works, but she never had any kind of IRA account. So being a financial planner, I said, hey, guess what, Julie, we're going to set up an IRA for you. Now, with our combined incomes, we can't do a deductible IRA because we participate in our work 401k plans, and we're over the income limit to do a Roth contribution directly. But I said my wife happens to be an excellent candidate to do what's known as a backdoor Roth, which what she does is every January is we put in, now that she's over 50, $7,000 into a traditional IRA, but we don't get a tax deduction for it. It's a non-deductible IRA contribution. And after the check clears, and it always does, we convert that to a Roth. And the taxability of that is zero, okay? And Julie's the perfect candidate. She does not have any money in a traditional IRA account, so we fund it each January with this non-deductible contribution. That's after-tax money. We convert it to a Roth. That's the backdoor Roth. They're shutting that down after 12/31, so we won't be able to do this anymore. Some of you should think about that between husband and wife. Sometimes people get married early in life. Maybe one of you, two of you didn't have much of a working life, has a small IRA balance, no IRA. You are a perfect candidate as long as you have earned income, which you do need to make any kind of IRA contribution. You have to have earned income, wages, self-employment income. You have a small balance IRA or don't have an IRA, you are a perfect candidate to do this backdoor Roth conversion. And this is scheduled to go the way beginning January 1st of 2022, okay? It's been a very popular strategy, and this might be a good time to set up a meeting with Mahesh to look over if you're a good backdoor Roth candidate, because this little party is ending soon. Okay, we looked at the tax rate schedule a couple of times. RMDs, required minimum distributions. Of course, they have a new age now. Age 72 is the new age for required minimum distributions. There is some talk about extending this out to like age 75. It's a back burner issue right now. They have much more important things to discuss in Washington, so we don't expect this to get back on the agenda to maybe next year. But what it did is it extended the ground to do distribution planning, okay? Which means is that, say you retire at 65, it used to be at age 70, you had to start taking RMDs, now it's 72. It gives you a little bit more room, for instance, to do Roth conversions or even pull money out of your retirement accounts if it's at the right rate. It's okay to start tapping into these accounts in the right tax bracket. It's all about your tax bracket, okay? So for instance, if maybe you were working, you were making 150,000 of income, all of a sudden you stop working and your income is way down. Well, you need money to live, so you'll be tapping some of your taxable account, but it might not be a bad idea to tap into your IRA accounts or 401k accounts to fill up those lower tax brackets. It's okay to be paying at 10, 12, 22%. You can fill them up with taking money out straight up or doing Roth conversions, okay? And what that'll help you in a few ways. One is you get the money out at a lower rate, potentially in the future. And then it will lower your potential RMDs when you do get to RMD age, which is currently 72. Okay, so keep that in mind. It's okay to tap these accounts a little bit early. We've seen some horror stories where people have these mammoth IRA accounts at age 70, back in 2019, or now at age 72. And they have 50,000 in their checking account. Everything is in an IRA. And of course, when they start pulling money out of the IRA, that creates a tax bill, but they don't have enough money in their checking account to pay the tax. They have to go back to the IRA. And you can see it's a very circuitous route, but just adding more tax dollars to the situation. You don't want to be that person. That's a ticking time bomb. That's why we like to get those Roth conversions and pull money out prior to age 72. Now, switching gears a little bit, we're talking about capital gain and loss planning. Here we are getting close to the end of the year. It can make a lot of sense, believe it or not. Again, accelerating income if it's at the right tax rate. Capital gain harvesting can make a lot of sense if you're in these lower brackets, 10 and 12%. Guess what the long-term capital gain rate is if you happen to be in the 10 or 12% bracket. So a married couple, as long as your income, including the cap gains, is below $80,800, you pay zero federal income tax. Now, if your income goes above that, your gains start to get taxed at 15%. And if your income goes above these numbers, it gets taxed at 20%. Now, the one thing this does not include is this 3.8% Medicare surtax, which actually kicks in on adjusted gross income, not taxable income, at these levels, 200 and 250. Just a reminder, adjusted gross income comes before taxable income. But it could make a lot of sense to harvest gains if I can pay at this rate. Absolutely. Once you get into higher tax brackets, okay, what we do at SCI in our tax managed accounts for you is we try to use market volatility strategically and harvest losses. Those losses don't expire, okay? And we certainly have managers that will be selling things at gains. So we marry those losses to the gains. We want to make money for you, but we don't want to pay any taxes along the way, because tax is by far your largest single expense when it comes to investments. And minimizing that is incredibly important so we can maximize the compounding of the return. Compound interest, compound returns is the greatest thing ever. And to do that, you really need to minimize that tax bill. Now, you don't want to go absolutely haywire with loss harvesting, because there's a limit to how much you can use in a given year. Okay, you're allowed to marry your losses to all your gains, and then you're allowed to take an additional 3,000 of losses in excess of your gains. Okay, and then the rest is carry forwarded to future tax years. So if you have the ability to tax loss harvest, that is something you might want to look at. And we do it certainly in our tax managed portfolios. So keep that in mind. Now,
Hey,
there are
Dean,
talking, go ahead, Mahesh.
I was gonna say I had a question pop up here from one of the participants, which was around capital gains for real estate. And I know you're just talking about investments here, but the question was, I sold my house in June. How do I minimize capital gains taxes? And I'm assuming it's at my house, so it's a personal residence. Do you know
Right.
what the limits are for personal residence for capital gains?
Well, one thing that you have in your back pocket, and as long as you meet the rules about ownership of the home, there's Code Section 121. Code Section 121. If you're a married person, you can exclude up to $500,000 of that gain. And if you're single, $250,000. Okay. Now there's some ownership rules, which I won't get into a little deeper than this call, but we can certainly review that with Mahesh. But if your gains are greater than 500,000, then we might need to start looking at, for instance, other strategies to potentially mitigate those gains, which would be tax loss harvesting and other parts of your taxable portfolio. You might want to, for instance, as we talked about, increasing your charitable contributions and maybe potentially some of the other itemized deductions, though there's not a lot that can be done with, say, as I mentioned, state and local tax or mortgage interest. So charity is really the one that you really want to beef up, which we're about to get into. But I think your biggest, I'm not sure how much gain we're talking about, but you can exclude right off the get-go 500,000 from tax, which is pretty nice. And then, of course, yes.
Oh, my question was, so anything over and above the 500,000 is added on to your income, and
Yes.
that would be subject to these brackets, correct? So if their current income plus the gain is over, let's say, the 445,000 or 501,000 for married filing jointly, they would essentially be 20% bracket for that capital gains.
It would be stratified over those brackets. So not the
Okay.
whole gain will be at 20, but some of it will be.
Got it. Thank you, Dean.
Mm-hmm. You got it. Yeah, in all honesty, I know people don't want to pay tax, but 20%. When was that? Another interesting point. Let me point this out. The date of the announcement of the House bill, which is known as the American Families Plan, was September 13th. If your house was under a binding contract prior to that date, okay, your top capital gain rate is 20%. Believe it or not, that particular law change that they're talking about, which is not definite, but any sales post 9/13, the top rate is actually moved from 20 to 25% once you get over 450,000 of income filing joint. Now, it sounds like your house sale was done before 9/13, and this would be the top rate. But anything after 9/13 is top rate could be 25%. Again, nothing's definite. We don't have anything signed in by the president yet, but it's certainly on the table. I want to talk to you a little bit about an interesting charitable giving strategy. Hopefully you have, if you haven't heard about a donor advised fund, you're going to learn about a donor advised fund. The donor advised fund itself is a charity. It's what's known as a 501c3. That's the IRS code section. So when you give to the donor advised fund, you get a charitable deduction. As I mentioned earlier, many taxpayers struggle to itemize. Right now, to itemize as a married couple, you need to exceed 25,100 in itemized deductions, which can be a struggle. For instance, most people don't get a medical expense because they have insurance. State and local tax is limited to 10,000. There's no miscellaneous itemized deductions anymore. You may or may not have a mortgage. And the only other thing that's left is charity. So in this particular example, this particular taxpayer, their total deductions totaled 24,100. The standard deduction is 25 when it's a married couple. They didn't exceed their itemized deductions. Excuse me, they didn't exceed their standard deduction. So what are they going to take? They're going to take their standard deduction, right? It's higher than their itemized. But what if we, as I mentioned earlier, instead of giving, let's say, $4,000 or $3,000 this year to charity and not itemize, they accelerate additional charitable contributions into this year. You know you're going to give the money in 22 and 23 and 24, but that's not tax smart because you're not going to get any deduction for it. By clumping those deductions into 21, you will get a deduction for it. But you say, well, Dean, I don't know if I want to turn 20,000 over to my charities in 1 year. They may look at me a little differently. I don't normally give that much in a given year. I understand that. So is there a place I can park it? Absolutely. So this is a two-part process. First, you clump your deductions into 21, and then you lump them into the donor advised fund, okay? And so it kind of works like this, okay? The donor, you, right? You contribute to the donor advised fund. Here, shameless plug coming, SEI has one. It's called the SEI Giving Fund. There's others out there. You receive a tax deduction for what you put in the donor advised fund. You could put cash in, okay, that's all right. Better yet, you could put appreciated securities in. So let's say you have stocks, bonds, mutual funds, etc., that have appreciated over the last 10, 15 years, let's say. Big gains in there. Well, you could sell those to write the check to your charity, but why would you do that? That's going to cost you money because you sold something in your personal account. That's taxable. And then you give the money to the donor advised fund or to your charity. Better yet, just donate the securities right to the donor advised fund. You get a twofer out of this. You got out of the gain, don't have to pay tax on the gain, plus you got the charitable deduction. That's a really tax smart move. Now our donor advised fund has a very small minimum, $5,000, has its own website. Once the money's in here, it grows tax-free. Mahesh can help you pick the portfolio that it should be invested in. And then later on, whenever you want, okay, you can pick the charities you want to give that money to. So if you put 20,000 in now and you normally give out 4,000 a year, well, you could do that. 22, you can give money, and 23, you can give money. You could skip 24, give money in 25, okay, however you want to handle it. Okay, you and your wife could run it, depending on how much money's in there. Even when you pass away, your kids could still be running this donor advised fund. This is like your little private foundation. Okay, that's what you can look at this, but you don't have anywhere near the headaches of the foundation. Okay, certainly you can't do a foundation for $5,000, but you have to file tax returns with the foundation. Everyone knows you have the foundation. Donor advised fund, it's private. You don't have to worry about any tax filings. All the administration's taken care of. It's a cool thing, and we've seen explosive use of this as part of some tax smart strategies, trying to maximize their charitable contributions and get a tax deduction because of the tax law change that took place in 2017. And if we're talking about doing Roth conversions, for instance, or accelerating other types of income into this year, whether it be stock option exercises, sale of a home, this is a great time to look at this donor advised fund, put appreciated securities and or cash into it, build up a big deduction to offset that other type of income, okay? And so we give some examples of here, like for instance, bonus or stock option exercise, maybe a realized capital gains. You don't have tax loss harvesting. It's a little hard to come by right now. Maybe you sold real estate or a business. This is the thing to be looking at, okay? This could be a family asset for years, okay? You won't be able to tap in it for personal use, but you can certainly let it grow and give to charities for a long time. Who do you want to write a check to? The U.S. government or to your favorite charities? Okay, why not get a tax deduction on top of doing some really nice, good things? And again, pairing a donor advised fund contribution with a Roth conversion. Really tax smart idea. And again, we do offer a donor advised fund, small minimum, only $5,000 gets you started. Okay. All right, let's talk about next steps because I've been running a little bit long. It's time to have your tax return reviewed. Okay. 2020 returns. If you haven't filed it, the deadline's just around the corner, October 15th. What has changed, if anything, in 21? What's on the horizon for 22? Tax planning is a multi-year exercise. We've talked about some things. Do I want to do a Roth conversion? Am I eligible to do the backdoor Roth? When you looked at your 2020 return, you didn't itemize. I do give to charity. Should I use the lump and clump and do the donor advised fund? Okay, we got to keep an eye on Washington. You know, what legislation is going to be passed this year? We don't know. Okay, get that little list together on what you might want to do. Am I going to accelerate other income into this year with the potential of higher tax rates next year? Then have that last meeting with Mahesh and decide what the strategy is going to be and execute. Okay, you might have to consult with your tax advisor. It might not be a bad idea to run a tax projection. Okay, I don't like to do things unless I know what the tax consequences are before I do them. Okay, so that's not a bad idea. And of course, my number one planning idea for most everybody is the Roth conversion. Okay, and here are just some disclosures that my legal team back at SEI would like me to show you. And with that, I'll turn it back over to Mahesh to see if there's any questions from our attentive audience.
Thank you, Dean. Thank you. Thank you for all your knowledge and all the ideas that you shared. Again, for attendees, if you have any questions, go ahead and pop them in the question box, and I will review them and read them off to Dean as well. In the meantime, I'm going to share my screen real quickly. In the original invite that you received, there were a couple of things that we had promised. And Dean, could you just check? Are you able to see my screen?
Yes, I am.
Okay, perfect. So a little bit about Strategic Wealth Design. We're a financial planning and services firm based here in Las Vegas with clients all across the country. We do specialize in working with dentists, physicians, and business owners, but our client base is not necessarily restricted to that. We certainly help other individuals and families as well. We're independent. We're fiduciary-based advisors, over 20 plus years of experience in the financial services. And then one of the things, the reason that we strategically partner with SEI is one of the things that we do and we enjoy is the tax side of planning. We don't do taxes. We work with accountants and tax accountants and your CPAs to coordinate and collaborate on tax strategies and long-term tax strategies that make sense for our clients in their lives. Sometimes individuals just want that tax deduction and save money on their taxes today, but many times they may forget the unintended consequences of that or really haven't planned out what the consequence of that would be in their retirement. So that's something that we do, and we work with your accountants and your CPAs as a part of our planning services. A couple of the housekeeping items. So we had promised everyone will receive this free tax guide. So you will receive an email, I believe either later today or tomorrow. I have to check with my office manager to see when she's sending this out. But you will receive this free tax guide that will be coming to you shortly. So just keep an eye out for your emails, and you'll receive a link to download this tax guide. The second thing that we promised was a complimentary tax analysis. So we use a tool, a software, where we're able to scan your tax returns in, and through technology nowadays, we're able to get a high-level overview. This is a sample of what this would look like, and then we can review some of the observations from your taxes and look for opportunities in your tax returns to save on taxes. The goal is not to replace your accountant. The goal is to collaborate with your accountant and come to the table with your accountant and review this report and be able to come up with ideas that either perhaps you may not have thought of, and look at ways to reduce taxes today, but also start planning for next several years. So this is, again, available complimentary. You will receive an email with a survey. A survey will pop up as soon as the meeting is done, so just hang in there for another 30 seconds to a minute. A survey will pop up right on your screen. If you don't mind, please take the survey. We'd really appreciate it. And in that survey, there's going to be a box, I believe, that you just check off and says, that you'd like to request a complimentary tax analysis. When you do that, we will send you an email with the instructions on the next steps and what needs to be done so that we can provide this report to you and review that together with you and your accountant. So, so if you'd like this complimentary tax analysis and a consultation, please check that box. We'll be happy to provide that. Next steps, again, please complete this post-meeting survey. If you missed the pop-up that'll pop up on your screen, please complete the survey. You'll receive an email within the next hour. So please do complete that survey. If you'd like to take advantage of the tax analysis piece of it and an offering, please provide the tax return for tax analysis. We'll send you further instructions after you complete the survey. Meet with us to review the tax analysis and observations. And lastly, talk to your CPAs, accountants, tax advisors, financial advisors, and certainly feel free to engage with us in financial planning because we do some comprehensive tax planning as a part of our financial planning services. So with that, I'm going to just take a look at questions here and see if anything is popping up. There was a question as to what's the maximum amount I can put into a Roth or the maximum amount that I can convert. So I'll take this, Dean. So the maximum amount you can fund into a Roth or a traditional IRA is $6,000 per year if you're below the age of 50, and if you're over the age of 50, you can do the $6,000 plus another $1,000 of catch up, so that's $7,000 total. So below 50 is $6,000 a year. And if you're over 50, then you can fund $7,000 per year into a Roth or traditional IRA. As far as the Roth conversion goes, there is no maximum limit on the Roth conversion. So you can convert, if you had $5 million in your traditional IRA account, you can essentially convert all of it to Roth, and that would be a pretty hefty tax consequence. But you can certainly convert all of it. There's no restriction on that, not at least today. And as Dean mentioned, that strategy is going away. Dean, you mentioned in 2032.
Yes, for the upper people in the top tax bracket, they will no longer be allowed to do a Roth conversion. One other place you could maybe do a Roth contribution is sometimes 401k plans have an option to do a 401k Roth. So that's another area that if you're interested in doing Roth contribution is to potentially get your 401k or 403b plan, for instance, and make Roth contributions as well.
Correct. Let's see. Oh, got away from my screen. Give me a second here. Another question that came up was, I think you addressed this, which was state and local tax deduction limitation increased. You mentioned that there is possibility that they're looking at increasing that as well.
Yeah, it's currently 10, but it wouldn't surprise me that it got bumped up to a higher number. We're thinking 15, but maybe even higher than that, but there should be some increase there.
One of the things you mentioned, Dean, was that the long-term capital gains tax rate the increase in the long-term capital gains tax rate is effective September 13th, so just a few weeks ago. Does that mean that mutual fund capital gain distributions could be subject to higher capital gains tax rate as well? Is that only applied to real estate or just all types of capital gains after September 13th?
That's a great question, and to be totally honest, it's not 100% clear. So in the case of real estate or any sale, they did make it say there had to be a binding contract, not that, we were talking about selling it to you, but had to actually be a binding contract. Now, mutual fund capital gain distributions, exchange traded fund distributions, et cetera, don't normally happen until November and December, which is well beyond 9/13. We should get clarity on that, but it would surprise me that they would not be subject to that higher tax rate since it's post 9/13. But we can't be 100% on that. We're looking for some clarity, and again, since we don't have an actual tax bill to discuss, but that would be our inclination that it would be subject to the higher tax rate.
Got it. And is there, you mentioned a donor advised fund can give to other charities. Is there a specific qualification? They have to be 501c3s. I know you heard of 501c6s out there. What's the qualification for a donor advised fund to give to another charity?
Yeah, I believe the code section that they look at, and I'm not totally 100% on, but the donor advised one is a 501c3, and I know they for 100% they can give to any other 501c3. So one of their jobs is Renaissance, who's the administrator of our donor advised fund. When you put in to give to a charity, one of the jobs is to check to make sure it is a real charity. So if you try to be like George Costanza and Seinfeld and name the Human Fund, which was a fake charity, they're going to catch that. So I'm not 100% on the C6. I'm not familiar with that particular code section, but you could always, they have a drop-down list on their online thing. So if you don't see that charity listed, then it's probably going to require a phone call, and you could get that cleared before you would say make that contribution. But certainly any 501c3 is totally 100% okay.
Got it. Perfect.
Don't be Costanza.
Perfect. Don't be Costanza. Yes. Well, we're running at top of the hour here. That's all the questions that we've had. So again, Dean, thank you so much for your time, and appreciate you doing this again this year. I believe we're going to have you back again next year, right?
Absolutely. I'm here for you.
And then hopefully you'll be in person in Vegas. So
I'm always willing to come to Vegas. It's my kind of town.
So thank you again. Thank you all the attendees. Thank you for joining us today. Hope you got a lot of value out of this. Please take a moment to complete the survey, and feel free to reach out to us if you have any additional questions. We'd love to be a resource to you. Take care.